on the financial planning case studies, I can share with you how mortgage pools can enhance fixed income, how they can help you with overweighted equity portfolios, provide for cash flow for retirement issues, and then of course longer lifespans. People are living longer than they've ever lived before and they don't want to run out of money. So an example could be that you have a $1 million investor and they've got a conservative portfolio. They got money markets and treasuries and short-term bonds, and they're getting 4% or they're getting $40,000 annually on their $1 million investment, and they need more cash flow. They need additional income. So a solution could be that if you were to allocate 25% of their portfolio to a mortgage pool that's generating 8 to 9%, you're going to increase their yield from 4 to 5.25. You're going to increase their cash flow or their annual income by $12,000 or a little over $1,000 a month. You'll further diversify their portfolio and you'll maintain some liquidity. A second issue that you might face is that they have overweighted equity portfolio. You got $1 million in tech and small cap growth stocks. They're getting a 4% blended yield across the board, and they need a higher return. And a solution could be, again, if you allocate 20%, you're going to further diversify their portfolio to 70-20-10. You'll increase their portfolio to 6%. You lower their risk because you've diversified it further and you've maintained their aggressive portfolio. Now, an issue that's happening clearly is going to be healthcare and retirement. Here's an example. Say you got a client that's 78 years old. The spouse is 70 years old and in excellent health. The older person has some issues. And due to the increased cost of healthcare and their lack of cash flow, they're going to need some more money to make sure that the remaining spouse, surviving spouse, has cash flow to last them for the rest of their lives. A solution could be to allocate 30% of their portfolio to a mortgage pool that generates 8 to 9%. That would increase their blended return to 6.2%, and it would stretch out their portfolio to 2025 when the surviving spouse is 88 years old, which may not be long enough because we got longer lifespans that are affecting us right now, and people are living to be 90 years old pretty regularly. So you got a client that's 75 years old and is in excellent health, and they're concerned about living to be 100. They got a family history of living to 90 years old, and they're worried they're going to outlive their assets. Now, the only person more broke than a broke broker is a broke 90-year-old. And you don't want to be broke when you're 90. So a solution could be to allocate 35% of their portfolio to a mortgage pool that generates a good, stable income, reduce their lifestyle expenses, and as a result, you could stretch out their portfolio to past age 100. So you can see that by a couple of simple changes or tweaks here and there, a mortgage pool can provide a lot of diversification, provide a good return, and some steady income streams for your clients. Let me show